So, dear Joe, Big Al, and Andy, we love your podcast. I have a question about charitable remainder trusts. I currently have $4 million in my 401k and $5 million in a regular brokerage account. I'm 64 years old and my wife is 58 years old. I plan to work another 5 years. I will start collecting Social Security when I'm 70, and at that time, my wife will start collecting her spousal benefit. Our combined Social Security at that time will be $60,000, so we can live off our brokerage accounts if need to. Our yearly expenses is approximately $100,000. I'm concerned about the taxes that my two children will have to pay on the inherited 401k, which they will have to withdraw within 10 years. Do you think a CRUT would solve this problem? Is there any taxes associated with a CRUT after my wife and I pass away, besides the taxes on the income that my kids will pay on income distributed out from the CRUT or Charitable Remainder Trust? Is there tax on the CRT trust on distributions to it from the 401k IRA after our death? Thanks, George from New York. A few things. So the stretch IRA was gone after the Secure Act.
Correct.
And what the stretch IRA allowed was non-spouse beneficiaries. So children, anyone but a
grandchildren, brother, sister, whatever, friend.
Yes.
Business associate.
Yes, a non-spouse. They could stretch the tax out over the beneficiary's life expectancy. So let's say if I inherited Big Al's IRA, I could stretch the tax out over, let's say, the next 40 some odd years. That was the stretch. So it stretched out the tax liability so that there was not a big tax consequence when you inherited retirement accounts if you didn't need to pull the money out right away. And so the Secure Act from a few years ago eliminated that. They said, no, we can't let you stretch that tax out over your lifetime. You need to pull the money out. The money needs to be completely distributed out of the retirement account within 10 years.
Right. And it can be same amount each year. It could be full amount first year, second year, 10th year, or however combination you want to do it. But by the end of year 10, it needs to be gone.
So here's the problem with George, right? George has got a lot of cash sitting in a retirement account. He's got $5 million.
Right.
But how old is George? 50. He's 64 years old.
Right.
So let's say, and he doesn't need any of the money because he's got $5 million in a brokerage account, and he's only going to live off $100,000 a year, and $60,000 is going to come from Social Security.
Yeah.
So he needs to pull $40,000 on $5 million, which is less than 1%.
Yeah. So he'll be fine. I agree.
So he's like, all right, well, here, my 401k is $5 million. He's 64. He lives to 74. That's going to be $10 million. And then he has to take RMDs at $10 million. So he's going to have to take $400,000 out of the overall account, roughly, if the account doubles within 10 years as an RMD, and then he's going to get hammered in tax. And then if he passes, right, there's this big, huge retirement account that's going to go to his kids. Let's say it's $10 million at this time. Well, they're going to have to pull $1 million out per year. Right. That's the least. I mean,
well, divided by two because there's two.
Okay, $500,000 out per year, or maybe they could do a combination as Al talked about.
Yeah.
But adding that much income is going to put you probably in the highest tax bracket.
Right, and so there is a solution. You can set up a charitable remainder trust, and that's actually a trust that generally gets set up. In this case, it's the beneficiary of your IRA. So what happens is when you pass away, that the beneficiary is not your kids; it's the charitable remainder trust, but your kids are beneficiaries of the charitable remainder trust, and it can be set up so that you have a life payment for each kid. So it could still stretch over their lifetime. There's some negatives because some of the assets have to go to charity. And if you die prematurely, if the kids die prematurely, then whatever's in the account goes to charity. So then the grandkids wouldn't get any. So just be aware there's pluses and minuses, but you can do that.
Yeah, the trust is going to be able to distribute the amount of money over the kid's life expectancy. So you still get that control if you want, or you can avoid the depletion within 10 years.
Correct.
But the negatives is that, right, you're going to have, if the kids die prematurely, everything's going to charity.
It's not necessarily eliminated from your estate, so you still pay estate taxes, and the kids will pay taxes as they receive distributions.
All right, hope that helps. We got to take a break. Show's called Your Money, Your Wealth.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.